or you can have, high inflation, or you can have hyperinflation. My sense is obviously they want to avoid a collapse. They want to avoid hyperinflation, but I'm quite sure that they'd be willing. I mean, it's a bad choice, but they'll be willing to live with high inflation because that's their only way out. So I think high
Yeah.
inflation is in our future, and that's why, the sound money assets, gold, silver, and Bitcoin are all, record highs and pushing higher because I think the market, I mean, those of us who are in this community have known this for a couple of years, but we've been sitting back and waiting for it to happen.
Hey guys, welcome back to Everyday Finance. In this video, Larry Lepard discusses Bitcoin and crypto. Cryptocurrency is more than just another form of money. It is a programmatic currency that possesses unique characteristics. Operating on a unique network, this cryptocurrency is making significant strides in various areas. It remains unaffected by government interference and benefits from the powerful network effects and increasing hash rates, ensuring its growth and security. Picture a world where every item, from your morning coffee to your future home, is priced in SATs or Satoshi. This isn't just a possibility, but a future that is gradually taking shape, similar to how industry giants like Microsoft and Amazon revolutionized their fields. Bitcoin is positioned as the foundational layer of currency for the future. Please consider taking a moment to support this video by liking it, subscribing to the channel, and enabling post notifications for similar content in the future. Please feel free to contribute to the discussion by leaving your comments and observations in the comment section below. Thank you, and enjoy the video.
And so, the Fed's got to find ways and means of getting people to buy the debt and make it look like they're not printing money. And, a change in the supplementary leverage ratio would be one way of doing that. So I expect the Fed to continue to, as much as possible behind the scenes, try to keep, the money spigot flowing, but try to hide it as much as possible as well, because they also know that everyone seeing that is going to therefore, anticipate inflation and pay, push the inflation rate up. Right. So, they're really, the Fed is really horribly trapped. And they can't, with the leverage that exists in the system, they can't stop printing money or else everything will collapse.
Right.
But in turn, as you and I both know, that printing of money is what leads to inflation. And they've got a lot of people complaining about inflation, rightly so. So they've kind of cooked the inflation prints, but they have managed, the prints have come down from, kind of 9 to 3. And my sense is, based on recent comments by Powell, that they're going to kind of declare 3 is good enough for government work. We're going to get to 2. And therefore we are going to do some cuts, because if they don't do the cuts, as I said earlier, that $1.1 trillion interest cost that the federal government is now bearing is projected to go to 1.6 by the end of calendar 2024. So that's another, $500 billion of deficit. I mean, that's the other thing I should point out, that I just think I'm in the process of writing my first quarter letter. And so several things jumped out at me. The biggest one, and these are things that everyone's known, but you got to put them together. In the first quarter, or the fourth quarter of 2023, which is the first fiscal quarter, because the federal government has a September year end, the government ran a $500 billion deficit. So if you annualize that times 4, it's a $2 billion run rate, and it's lumpy, and that may not be right, but it's close. In turn, they also recently, as well as Washington Times headline that said in 100 days, the government debt went up by $1 trillion. So U.S. federal government debt grew by $1 trillion in 100 days. Well, there are 365 days in a year. So if that rate were annualized, that would mean the federal debt is growing by $3.65 trillion per year, which is a lot bigger than the $2 trillion deficit, and which would probably represent a growth of 10% in the federal debt. Whereas in GDP, I think is growing at around 2.6 or 2.8. So they're trapped in a mathematical doom loop where, the debt just keeps growing faster than the means to pay it. And really the only way out, I mean, Reinhardt and Rogoff and all the studies have shown that, in all countries that have done this, where they've got the debt to GDP as high as it is, they're kind of three ways out. You can have a collapse, a debt collapse, and all the debt defaults, or you can have, high inflation, or you can have hyperinflation. My sense is obviously they want to avoid a collapse, they want to avoid hyperinflation, but I'm quite sure they'd be willing. I mean, it's a bad choice, but they'll be willing to live with high inflation because that's their only way out. So I think high
Yeah.
inflation is in our future, and that's why, the sound money assets, gold, silver, and Bitcoin are all, record highs and pushing higher because I think the market, I mean, those of us who are in this community have known this for a couple of years, but we've been sitting back and waiting for it to happen. And what's happened now is it's becoming very clear. Everyone sees it. So that's what the markets are telling us. They know what's going to happen, even though the Fed hasn't formally pivoted. Although in his most recent press conference, Powell did say they might start reducing the quantitative tightening, which is by itself, that's a form of easing, right? I
Right.
thought it's interesting. He said they might start doing that because they didn't want to encounter a problem similar to the problem they had in September of 2019 when the repo market fell apart, and that led to the first Powell pivot. So what you've got here is a federal agency that the market knows what they're going to have to do. Maybe even they know what they're going to have to do, but they're trying to delay it and hide it as
Right.
long as they can.
Yeah.
But the market's calling bullshit, and that's why these metals are working so well. And this is a continuation of what we saw. I mean, we had a version of this in the fall of last year, right? As you'll recall, in September, October, the U.S. 10-year yield went from, sub 4, around 4, up to well over 5 very quickly. Kind
Right.
of reminded me of the UK gilt crisis the fall before, that caused Liz Truss to lose her job and for them to reverse their quantitative tightening and so forth. And this was in my fourth quarter report. We wrote about this, how when that happened, the alarm bells went off at the Fed, and they very quickly had about 15 Fed speakers saying, well, tightening cycle's over. Interest rates have done what we need them to do, and we're good. And so immediately bond market said, oh, tightening cycle's over, more easy money coming. That means bond yields are going to come down. And so the Fed, they jumped on it, and it brought the 10-year back down from over 5 to under 4
Yeah.
in a relatively short period of time.
Really quick.
Yeah,
Yep.
very quickly. And so it just shows how they can jawbone and they can manipulate these markets. But in the longer term, the trend is what it is. And, I believe we firmly have an inflationary trend going on here. I mean, when you see, wages or any kind of metric that you look at, more recently, it's commodity prices are hitting all-time highs. I mean, the price of cocoa just blew out. I mean, that's, related really more to a supply issue with the cocoa farmers in Africa. But the point is that, oil has been strong. I mean, it's up over
Yeah.
8 weeks again. I mean, inflation is there, and Tavi Costa has a great chart that he puts up very often on Twitter where he shows that in the 70s, an inflationary decade, there were waves of inflation. You get the first wave and then they tighten and it comes down, but it's at a higher, the low is higher than the old starting point. And you get the next wave and they tighten, and so forth. And so, I think that's what happened, right? I mean, in 2020, 2021, they were complaining they didn't have any inflation. Then they got some, they said it was transitory. Then they realized, oh no, shit, it's a lot more than transitory. This is a real damn problem. And
Yeah.
they jumped on it, raised rates really quick. And
Yeah.
that brought headline prints from 9 down to 3, but, off they went.
In the past, Wall Street has not consistently prioritized the well-being of the general public, as evidenced by the events of 2008. The financial crisis serves as a prime illustration of how the major banks engaged in a game where they consistently came out on top, leaving others to suffer the consequences of significant financial turmoil. Fast forward to the present day, and we find ourselves in the midst of another transformation in the financial landscape with the emergence of Bitcoin ETFs. While these financial products aim to bring Bitcoin into the mainstream investment world, they also come with their fair share of risks, especially from a regulatory standpoint, particularly for those heavily invested in cryptocurrencies. It is important to consistently diversify your holdings and consider self-custody options to maintain control over your digital assets. This approach goes beyond investment strategy and is about safeguarding your financial autonomy in an uncertain future. As we navigate the evolving role of cryptocurrencies in global finance, it is crucial to remember that the landscape is influenced by both technology and power dynamics. What are your thoughts on Bitcoin, ETFs, and the future of cryptocurrency? Feel free to share your opinions in the comments below. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.